All right, hello everyone, and welcome to our tax strategies class. In this class, we're going to be going over some of the strategies to help you keep your wealth as you go out and start building it in real estate. It's very important to keep that wealth. If you think about lottery winners, there's not very many lottery winners after 5 years that are still rich, and the reason why is because they've never learned the strategies to actually hang on to that wealth once they've received it. So as business owners, as entrepreneurs, and especially as real estate investors, it's very important to understand what your highest expenses are. And definitely taxes are at the top of that list. So the wealthy use tax strategies and their understanding and knowledge of deductions and how to navigate the tax law in order to minimize legally, morally, and ethically the amount of taxes that they're paying to the government. So today, we've brought in an amazing professional who's got a lot of experience. We've got a practitioner instructor for you in the studio today. His name's Joel Jensen, and I want to tell you a little bit about Joel. He's been a CPA since 1996. So he's got years and years worth of experience that he's going to share with us today so that we can go out and start building our real estate empire in a safe and sustainable way. He worked for Ernst & Young, a very large firm that has a lot of clout, and he took that experience from Ernst & Young and he went off into the private sector and started building a private practice since 2003. So there's not very many people that I know of that have more experience and more knowledge around this area. We are very lucky to have him in the studio today. Now, as we dive in, I just want to share our quick disclosure that we have to share at the beginning of every class. Remember that I am not a licensed attorney, accountant, financial advisor, real estate broker, or any other licensed individual. I know that Joel here is a licensed CPA, but today he's not acting in that capacity. We're not trying to give anybody specific counsel today. No individual advice or instruction is going to be given. This presentation is intended to be general information. We've got a lot of knowledge here, and we just want to share it with you. But make sure before you try to apply any of these strategies that Joel's going to go over into your personal financial situation, you consult your own CPA and your own attorney to make sure that that those decisions that are going to have a legal impact or a financial impact are right for you. So. I'm going to go ahead and turn the time over to Joel. I'm going to let him tell you a little bit more about himself, and then we'll go ahead and dive into the class.
Okay, thanks. Appreciate that, Mitch. I want to rewind just for 1 second because I really like what you said in the very beginning about the lottery. So before I get into, about myself, let me just tell you this. I love looking at lottery winners. And the reason I do that is because I think of their mindset at the time that they win the lottery. Everyone thinks, I just won that record-setting 1 point whatever billion dollar lottery, right? But in my mind, if you said, hey, Joel, you just won $300 million. You hit the jackpot, $300 million. The tax mind in me is going to say it's not really $300 million, right? What is my cash payout? And then what is the tax I owe on it? And realistically, it's only about 80, right? So it's your mindset that you have. And I like to use the lottery example, especially when we go into real estate. If someone goes and does like a fix and flip, for example, and they say, hey, I just made $100,000 off of that fix and flip.
Yeah.
I want their mindset to say, okay, it really wasn't $100,000.
Right.
What is my tax effect on the income I make? How can I change my mindset to say, okay, realistically, it's $70,000 that I just made, and that's what I have available to put into my next deal because I got to pay my partner, the wonderful IRS, in every single little thing that we do, right?
Yeah.
So I like that mindset. So although this is tax strategies, I also like to call it a little bit of tax therapy.
Right.
So we can, talk about that. But I want to change your mindset a little bit as we kind of go through this. So let me give some background on myself. Thanks for the intro on that. So yes, I graduated with my master's degree a long, long time ago. And if you could see me, the gray hair and my sideburns would suggest that it was the early 90s. And out of college, I went and after my master's, I went and worked for Ernst & Young. At the time, they were the Big Six. Now they're the Final Four, as I like to call them.
Nice.
But it was a great learning and kind of a paid continued education. Right? Because they paid you nothing and worked you to death, essentially. So I did that for about 10 years and then decided that I was working with large companies and corporations and doing lots of assurance services work, financial statement work, SEC filings, all these kinds of things. And I just found that I enjoyed working with individuals much more than I enjoyed working with large corporations, where I feel, what is my difference in a $4.4 billion,
Right.
company? Whereas if I can get in front of you, for example, or in front of a real estate person who makes a couple $100,000, now there I can make an impact, right? I can make a serious impact on how much money they make, what they can save, kind of their financial future. And there I feel like I have value. So 2003 is when I left Ernst & Young, and we'd started the firm earlier than that, late 90s. I was kind of dabbling on the side, and then decided, this is full-time, this is what I like, so I'm going to leave and just go into private practice, and I've been doing it ever since. And the reason I tend to focus on real estate, and I don't know if you knew this or not, but I'm a real estate person as well. So I do fix and flips as well myself.
Very cool.
I also own commercial rental properties myself. And so the reason that it helps within a real estate tax client, for example, is because I do it, right? And naturally, human kind of behavior tends to favor that I want to make sure I'm getting the best deal for me, right? Especially when it comes to the tax code. And so it helps me learn, and I'm going to learn the most for myself, right? It helps me learn, and then I take all that information I get, and then I go and I help my tax clients with that. So because I'm a tax guy and I'm also in the real estate game, it kind of makes me a unique kind of individual when it comes to trying to help people with real estate.
You got firsthand experience.
Because I have firsthand experience, because I do it. Yeah, so let's get into this wonderful little Tax Cut and Jobs Act. That was a nice little tax code that they passed a couple years ago. This is going to be what I call our second season with this new tax code, because we're now in the midst of busy season. It's our second season. We had one season to get through it, and it was quite a unique experience. So let me give you two examples real quick about what that was like. So first one is I have a client who lives in Los Angeles, Beverly Hills actually, and he's a scientist, okay? And he sends me his tax information every year. I've done his tax returns for quite some time. But I know exactly how he's going to send it to me because he's a scientist. So it looks the same paper, same layout, same details. You could literally just change the year and they're all identical if you put them side by side. So I know what I'm getting when he sends his stuff to me. But it's a new tax code, right? New tax code. So I get his information. I said, thanks. His name's Michael. I said, thanks, Michael. I appreciate it. Let me go through it. And I'll get back to you when I'm done. And then we got to talk about it to see how this new tax code affected you. And so I did that, sent it to him. I said, okay, let's get on the phone. Let's go through it. And last year, tax return, the 1040 even looks different than this year. But last year, if you remember, you go to page 2 and that's where all your information is. And we got down to the bottom of page 2 and he was getting a $10,000 refund. Okay, $10,000 refund. In most cases, people will be super excited, right? 10 grand back in my pocket. Awesome. It's like, those tax refunds are like free money. People, kind of have this mentality, free money, I can go spend it and go do whatever I want with it. Right. So he's getting a $10,000 refund. His response to me, his reaction to that news was, that's it? That's all. 10 grand. That's all I'm getting is 10 grand. I said, okay, Michael, let's take a step back for a second. New tax code. Let's look at it. Let's compare apples to apples. What were your withholdings? Did your paycheck go up a bit throughout the year because you're getting part of your refund that you got in 17, right, during the year rather than one kind of lump sum at 18? So we went through it. We compared those things. And it turned out he came out ahead, right? But it's just how the money got distributed because we're dealing with these new tax structures. Okay, conversely, I had a real estate client who lives in Texas. Her name is Jen. And in 18, she sold three rental properties. So she had gotten in contact with me as she was kind of moving through that process, and we had worked out various scenarios, gone through numbers, kind of helped her understand what she may have to pay based on the gains that she was making, which were really healthy. So we go through that process. Then come tax season, she sends me all of her information. I go through it, same process like I did with Michael. So I said, okay, thanks. I'm going to do your tax return, new tax code. I'm going to send it to you when we're done. Got to get back on the phone, go through it again. So that's exactly what happened. Sent it to her, said, okay, let's get down to page 2. We talk about it for a while. At the bottom, and then I tell her, you owe $60,000 to the IRS. 60 grand. now. What do you think her reaction to me was?
Hair on fire.
Hair on fire? No, this is what it was. That's it? That's all I owe.
Really?
That's all.
Yeah.
You're a genius. I said, thank you very much. But the issue and the difference between those two are expectations. That's what I learned last tax season. Expectations. Your expectation is going to drive how you feel at the completion of a tax return, like if you're sitting with your CPA or whoever does your taxes and you go through it. But it's your expectation, right, of whether or not you owe or get a refund. Either way, right? That's almost irrelevant. But it's your expectation that's going to drive kind of your behavioral reaction once you see the outcome of that tax return. So as we kind of go through this, I tell people, change your expectation. When it comes to the actual tax return, we're talking about tax compliance at that issue. That's simply filling out forms and trying to ensure that everything is done correctly, and you're going to submit it to the IRS, and if you have a state agency, submit it to them as well, and go through that whole process. But really, a lot of what happens with the tax code should be happening during the year, right? So if you came and you sat down with me right now and said, hey, Joel, here's all my tax records and everything. Help me out for last year. What can I do? And I'm going to be like, man, last year ended December 31st. You know, you kind of tied you tied my hands a little bit, right? So I want people to kind of look at this and say, taxes do not occur once a year in February when I go see my CPA and I drop my books off to him. Taxes occur all year long because you have a partner that is, quite frankly, vested in you. Wants to take your money, right? We have quarterly payments, withholdings if you have a W-2. They're getting their share all throughout the year. And so you should be planning all throughout the year and kind of, how do I deal with this person? What is afforded to me? What can I deduct? Or how can I deduct certain aspects of my operations to put me in the best position possible when you finally sit down, like right now, and I actually comply with the law and do your tax return. I've
joked when I've taught fix and flip classes before, because that's such an important part, and we always talk about budget for your construction costs, budget for your utilities, all of that stuff. But the thing that people always leave out is the taxes that happen after the fact.
Right.
And I used to joke from stage as I would teach the fix and flip course from stage is Uncle Sam's the unexpected partner. Right. He's standing there with his hand out at the end of the year,
day.
like, where's my cut?
That's right.
So yeah, absolutely.
You have to plan for it, right? You've got to change your expectations.
I was told one time that the biggest key to tax preparation is preparation.
Oh, that's a good one. I like that. It is totally true. Preparation.
Yep.
Right? Preparation. So let's go through some of these things, a couple of these things, and I like to tell people, kind of using those examples, that you need to adapt. Right? We have a new tax environment. We need to be able to adapt into that environment. If I can kind of share a personal story with you really quickly.
Yeah.
So years ago, I went and, in my early 20s, lived in France for a while and was trying to learn the language, right? Totally new environment, new language, different kind of social structure and how people, went about their day and so forth. And I was trying to learn how to learn how to do it, learn how to, get myself immersed in it, so to speak. Anyway, so I had a friend, and I was in the city of Marseille, if you know where that is, south of France. And I was talking to her one day, and of all the things that I missed about the States, if you can believe it or not, I'm in France with some of the best food in the world, but I missed Mexican food.
Nice.
I love Mexican food. I'm a spice junkie, chips and salsa are my jam kind of thing. Right. So I'm in the south of France. I'm saying, I'm talking to her about Mexican food and how much I love it. Anyways, there happened to be one Mexican restaurant in the city of Marseille, and she decided to take me to it. I said, awesome, I'm going to go there. And so we get to the restaurant. I said, let me order for you, right? Let me do it all. So I order this stuff in my horrible French, and they bring it all out, and there was a bowl of jalapenos there. And she went, and she's asking me about them, and I tell her, oh, yeah, they're hot. Okay, they're hot. I wanted her to know they're hot. So she picked it up, threw it in her mouth, started eating it, and then as her face goes bright red and the sweat starts pouring down on her forehead, she chastises me that the word for hot in French is not the same use as we use it here. Spicy and hot, two different words. They do not correlate whatsoever. And so I had unfortunately used the wrong word. I had not adapted to that environment, and she got the brunt of that pain by the use of popping a jalapeno in her mouth. So that's just a little example about changing to your environment. But when it comes to the tax code, that's what you got to do. We've had 1 year under this new environment. Not everyone has changed. Not everyone has adapted. Not everyone knows what they are afforded. But that is part of your responsibility as a business owner. Right? I'm in real estate. I'm a business owner. Sometimes people who even own one investment property, maybe they have one rental property, they think, oh, I'm not in business. No, you're in business, right? You are in business. You are a business owner. Your product just happens to be a piece of rental real estate. Right. So you need to know what's going on with my current environment, right? My current environment. And I also like to tell people, you need to optimize your business strategy. Okay, your business kind of structure on what you're doing needs to be optimized in order for you to, one, to put the most money in your pocket, not overpay Uncle Sam, and put money away for your future. So I always like to look at it at 3 different things. I say you need to have the proper entity structure for what it is you're doing in real estate, because there are, and we'll go through this, different types of real estate, which may require different types of entities. So you got to have the proper entity structure. Then we look at our tax structure, which for me is more of the operational aspect. What's the money that's coming in? What's the money I'm spending? How can I convert maybe items I may have bought for myself personally into a business use and get more deductions and so forth? So what is my tax structure or my operational structure? And then I've also got to have the proper retirement structure in place as well for the money that I'm making off of real estate. So I look at those 3 areas as kind of my business optimizational aspect. But today we're going to talk about the tax structure piece. Okay. So tax reform, right? Here's the various tax rates. Now, if you were to ask me if I have all these memorized, my answer would surely be absolutely not. Right? I don't. But I like people to look at this because I need them to have a sense of where they may fall. Again, going back to that lottery example, right? If I won $300 million, which tax rate do you think I'm going to be in? Well, 37%. So in my mind, I'm going to think, oh, I owe 37% plus my state. Maybe I'm in the low 40s, and I'm going to be left with 45, 46% of that money. That's how you got to start thinking. So conversely, I also want you to think of a deduction in terms of these tax rates. So if I go and buy, Apple just came out with their new iPhone, 11? Mm-hmm. So an iPhone 11 Pro, I was in AT&T the other day, maybe $1,200-$1,300 for a good one. When I look at that $1,300, I say, okay, it's not $1,300 to me because I'm going to tax affect it with whatever tax rate I am sitting at, right? And so maybe it's only $800 or $900 to me.
Yeah.
So I'm really finding tax savings in everything I'm buying if I'm buying it for my business. It's like, I often like to say, hey, the world's on sale if you're in business, right? I mean, you can look at everything as an effective tax rate on what I'm buying. Yeah. So that's why I put this up here. I just want people to think of it kind of differently. If I make money, what may I owe? Kind of generalities to the IRS. Do I know what my absolute income is? And then on the flip side, when I'm buying something for my business, what am I actually paying for it? Yeah. Right? So I also like people, I'm a tech junkie. So I always opt for the best of whatever it is, phones or iPads and stuff like that, because I know, man, I'm getting a 35% deduction on that stuff or whatever it is. So that's how I want people to start to think.
What's interesting is we weren't taught that way. So I know, my students know that I talk about it in almost every class, but I wrote a book in 2015 called Mindset to Millionaire. What really got me into real estate investing was I got tired of working a job and not understanding why the wealthy are wealthy. And I had made some pretty bad decisions in my early career when I was 19, 20. I didn't go to college. I kind of slacked off for a little while, so I didn't have a great resume. And so when I hit my mid-20s and decided that wealthy was something that I still wanted to do, I was a little bit deflated because I knew that I didn't have the credentials to be able to jump into something job-wise. And so I started studying the wealthy, and I realized they're just like us in every way except for the way they think. Their mindset is different. That's why the book's called Mindset to Millionaire. We weren't taught in public education, in elementary school, middle school, high school, we weren't taught to think of taxes as something that's fluid.
Right.
We were taught to think of it as something that you're going to have to pay, and it's structured. And when it comes to income, they basically teach you one path: go to school, get good grades, so you can get into a good college, get a degree, and get a job. And what I came to learn when I was studying the wealthy is the W-2 is the most expensive way to make money when it comes to taxes, right? Because there's the fewest deduction categories. Whereas something like real estate, being a business owner, opens you up to all of these types of deductions, and you nailed it. The wealthy, they've got that in mind as they're looking at these different things. We want to go on vacation. All right, can we make it a business trip?
That's right.
Right.
How do I convert it?
Yeah.
Everything's...
I need a new cell phone. Can it be a business phone?
Right. Exactly.
And then we can take that deduction from it.
Yeah. So I always like to say, people say they want to ask me, hey, can I deduct this? I say, change that question to how do I deduct this? Right. How do I do it? So that's a great analogy. So anyways, going back to this, just understand where you're at. Just kind of have a basic premise of where am I from a tax code standpoint. But I want to take a few minutes to go through some of the changes that happen. The big one typically that people look at, or some of the big ones I've listed over the next few slides, the state and local tax one was kind of a hot topic, being capped at $10,000. That would include property taxes, or if I have a state tax that I got to pay, state taxes as well. Other sorts of state taxes are included in there, and we've capped it out. And the people that tend to get hurt by this are my coastal states. Okay, California, New Jersey has one of the highest property tax rates in the nation. So my coastal states tend to get hit by this. Why? Because my state taxes tend to be higher, like California, brutal. Right, 13%. I mean, it's huge. And everyone gets kind of capped out. And interesting enough, on this particular one, when it first passed, this would have been, I guess, winter, right, November-ish of December of 2017 ish time frame. I was in California, and I had a client who's a real estate guy. He owns a bunch of commercial buildings, lives in back in Illinois. He called me and said, listen, I see this stuff on the state and local tax issue. There's no way that I'm going to be able to deduct everything next year. So I want to prepay it. I want to front load all my property taxes in 17 because I don't think I'm going to be able to deduct them in 18 based on the new tax code that's been passed. And I said, oh, I see that in the news. It's kind of, public is talking about it. But I said the inherent problem with that is that when these new tax codes pass, we don't know how the IRS is going to interpret all this stuff, right? We don't have any history of tax court cases that are associated with it. Yeah. So you're kind of flying by the seat of your pants if you want to do that. I may suggest you don't. And we kind of discussed it. One may say that we argued over it. But in the end, he decided, okay, I won't do it. I kind of convinced him after thorough discussion not to do it. And lo and behold, about 2 weeks later, the IRS comes out with a bulletin. Largely, I think, personally, is because it was in the news and people were doing it. And what this bulletin said was that unless the tax, state tax or property tax, has been assessed, you cannot deduct it, even if you prepay it. So the assessment is what triggers the deduction, not the payment of the tax.
So can you go into a little more detail about an assessment?
So assessment, yes. So every state, I'm going to say most states, right? But states typically assess property tax in the year you have to pay it. So we're in Utah right now. We start to get notices in the fall around August kind of time frame. Hey, this is where we think your property taxes are going to be. This is what we have a proposed budget. This is what the budget was or what was actual last year. They compare them. You get that notice, right? And you go through it. Then you get a little upset when you see what's happening to your property taxes. And then you kind of shove it away. Yeah.
November.
The November comes, right? But that's when the assessment occurs, is in November here. So had you paid it last year for this year, but the assessment doesn't happen until this year, you can't deduct it on your tax return.
Oh, interesting.
Yeah, so they use words. The IRS likes to use words into their favor, things like that, that promote, obviously, collections on their behalf. So what happened in the end is that had he paid it, he wouldn't have been able to deduct it in 17 because most states do it in the year that you pay it. California has a split year, and I know some other states kind of do it a little bit differently. But for the most part, it's in the year you pay it. So all those people that prepaid, the IRS was saying, nope.
Can't take those deductions.
Can't take those deductions.
Just for the 17 taxes.
Yes.
Okay.
So it's capped, right? It's only what had been assessed. And then next year, in 18, because we're cash-based taxpayers, and the cash would have occurred, the payment last year, I can't even
deduct
include
that
it
either.
in my 18. So that's lost money,
Yeah.
right?
Wow.
Lost money. So the point of this whole story is that you've got to be up to speed on what the IRS is doing,
Yeah.
right? You've got to kind of be up to how they're interpreting tax code, how they're interpreting law, and the things that we're seeing, from our kind of database of or our kind of client group as a whole. What we're seeing, any notices they get in interactions and stuff, gives us a sense of how the IRS is interpreting these things. So just be aware of it. Be aware of it, right? Personal exemptions is another one. That got eliminated with this new tax code. So those people with a bunch of kids are probably very upset. I have a couple kids, made me a little upset.
Yeah.
But they got rid of personal exemptions. The other thing that, as we kind of go through some of these changes, to realize is that the IRS has a budget every year, right? Of how much money they have to operate. Right now, it's $11.1 billion, roughly, is the money they get. About 50% is used for enforcement. I don't know if you knew that. They spend
Really?
a lot of money on enforcement.
IRS enforcement?
IRS, yeah. So like you, me,
audits and-
audits,
yeah.
collecting tax. About half of it's used on enforcement.
I had no idea.
Because you got to think, if they're using 5 or 6 billion to collect how many trillions, right?
Yeah, right.
Payoff is really good.
Yeah.
So about half of it's used in enforcement. But when they make these tax changes, that doesn't mean that what they have to collect goes down. Typically, every year, what they have to collect goes up. So if you were looking at a scale, for example, that scale always has to balance. So if I give deductions on one side of the scale, that means I got to collect more money on the other side of the scale to raise it back up and make sure that these things balance out.
Yeah.
So sometimes you'll look at certain areas of the tax code and say, hey, that hurts me. And then you'll look at other areas of the tax code, oh, that's beneficial for me,
Right.
right? So it kind of depends on which camp you fall in. That's why we always say the taxes are so individualized that, we can go through this presentation and go through a lot of generalities, but when it comes right down to it, you kind of got to talk to someone about your specifics on how all this stuff is going to affect you. That's probably the best course of action, right? Sit down and really go through it, but take this as a general knowledge base, right. to work with.
Okay.
So the child tax credit, right, that got raised. So that's one of the things where they are giving back. I'm taking away your exemption, but hey, if you got some kids, I'm going to give you some tax credits to help you out. The healthcare costs, right? 10% 2019. The mandate's gone now, so you know. So if you don't have health insurance, you're not penalized anymore, right?
No,
Which is
I actually didn't know that.
yeah for 2019. So
Yeah,
that
wow.
went away. It was a way of they couldn't reform healthcare. And by the way, when I talk about maybe political items, I'm not talking. I'm neither. I like to think of myself as neither right nor left. I'm all tax, right?
Right.
I'm the tax neutral person. I got to tell you,
Right.
this is the tax code, and you got to be informed of what it is. So healthcare costs, they couldn't reform it, so they got away with the mandate. It's kind of their way of doing a slight reform, I guess. But that's gone in 2019, so you can be aware of that. But probably the largest one on all this list is the standard deduction, right? That went up to $24,000 for those married filing jointly. The reason that's a good thing is because I think it was listed at roughly 71-ish percent, 70% of people use the standard deduction.
Right.
So that's why they raised it as one of those kind of giving things. They raised it up because most people use it.
Yeah.
And we're gonna take away those exemptions, but we're gonna give you things on the back end to kind of make up
Balance
for
it
it,
out.
to balance that scale back out. So that's $24,000. So often I'm seeing more and more people actually now take the standard deduction rather than itemizing. So if you don't own a home, it's really hard because you're not paying interest or property taxes. It's really tough to get to that 24 grand unless you're very charitable, which if you are, awesome, right?
Right.
Take advantage of it. Okay, if you were going to ask me the reason this whole thing got passed, this would be it. Okay, lowering our corporate, that's the C corporations, okay, specific to C corps, lowering our corporations' tax rates from some of the highest in the world down to, let's say, middle of the pack.
Right.
Okay, 21%. I think that's what they were trying to do. And the reason I think they did that is to try to encourage businesses to reinvest back into the States rather than taking all these jobs overseas.
Yeah.
I think it was, in their mind, an economy push, to get things rolling, hire more people, stimulate the economy. And I always like to say, people ask me, well, did it work? And I say, I don't know.
Yeah.
Ask me in 5 years or, 8 years from now if it works.
We'll find out.
We'll find
History
out.
will tell.
History always tells on these things. But when you're in it, I don't know. We just hope for the best.
It's interesting because things like this, I'll hear people say, on the news or in just conversation about it, that we're giving tax breaks to the rich again. We're giving tax breaks to the rich, right? As I started studying the wealthy, and my purpose for studying the wealthy was so that I could emulate them, so I could mimic them. Because if I do the same things the wealthy are doing, I should get the same results, right?
Right.
But the interesting thing that I realized about the tax code, which kind of reframed it in my mind, like I said, I'd always thought of it as this rigid, like everybody has to pay taxes, and it's a 37% or whatever the rate is for wealthy people, or for people making over a certain amount, and like it was just this static thing. But what I realized is the tax code really is an incentive program. It incentivizes the creators. For those who are willing to go out and create jobs through business, and for those who are willing to go out and create housing through real estate, correct me if I'm wrong here, but I think there are more deductions for that than for those two activities than really anything else.
Yeah, so I like to look at it. So there's a economic behavioral aspect to kind of the way the country is run. A subset of that is the tax code. The tax code is used to influence behavior as much as it is to collect money. And oftentimes people don't realize that.
Yeah.
So let me give you an example. So back 2008, do you remember what was happening in 2008, 2009?
Yeah, absolutely.
So real estate, right?
You're right. Yeah.
Plummeted into the dumpster, right? People were foreclosing all over the place, losing homes. That was going on. So what did the tax code do? So the people back in Washington at that point said, hey, housing is getting crushed. Housing is a huge part of the economy, right?
Right.
So we've got to incentivize people to go out and buy homes.
Yeah.
So what they do, first-time home buyers credit. They did that as a reaction to what was happening in the economy, because I want to influence your behavior now to go buy a new home. I need people to buy up all these foreclosed homes.
Yeah.
So I'm going to incentivize you to do it, right? So that's one way that they did it. The other thing to think about is there's very little. If you were to look at all the tax code pages, don't ever do it unless you want to. Unless you're in, can't sleep, that'll put you right out.
No, I just throw on some Joel Jensen. That's how I get my information on taxes.
So if you were to look at all the tax code pages, for example, there's very small amount dedicated to reporting income. Income is income. Hey, I got paid. Great income, right? But think of all the pages dedicated to deductions. Most of the tax code is dedicated to deductions. Why? Because I want to influence your behavior.
Yep.
If you want to go out and start a business, I'm going to let you deduct all this stuff. I want you to do that.
Yeah.
Right? You hire some employees, awesome. I'm going to let you deduct all these costs associated with employees and benefits and all these things because I want you to do that.
Creates jobs.
It's create jobs.
Yep.
So when you think of the tax code, think about more than just collecting money. It is behavioral economics.
Right.
And it's at a grand scale.
That's
right?
That's a great way
To influence people on how they behave and what they do and how they act and where they spend their money and all those things.
Yeah.
So this is just one of those. This was behavioral economics at a corporate level rather than an individual level to push companies back into the states.
Yeah.
Right? To push companies to grow their kind of footprint here in the States. And this is one of the ways they did it. Now, this is just kind of a reflection of tax codes across the world. So you just would have an idea of kind of where we sit, and we sit kind of right in the middle of all these. We used to be way up, if you could imagine us before this, way up on the far left, one of the highest, and now we kind of sit in the middle at that 21% mark. So let me tell you this. So that was for C Corps, right? They lowered all the tax rates for C Corps. I'm not a C corporation, right? I'm a small business owner. I'm an LLC or an S corp, or even if I'm just self-employed, just sole proprietorship. What about me? I'm doing business too, just like the corporations are. Where's my reduced tax rate? Because I showed you where the tax rates were earlier, right? But where's my reduction? So this is what they came up with. This qualified business income deduction. And I don't know if you're aware of it or not, but if I'm self-employed, this allows me to take 20% off of my income level before it hits my taxable income. So let me just kind of map it out for you, right? So let's say I perform services, whatever that service may be. And for the services I performed during the year, people paid me $150,000. So my collections of receipts, revenue, $150,000. In order for me to perform those services, I had expenses. My expenses for the year were $50,000, right? That goes office and supplies, phone, internet, computers, all those things. So my taxable income is left at $100,000. Okay, $100,000. When that goes into my tax return, this qualified business income deduction then looks at that and says, hey, okay, that $100,000, I'm going to give you a 20% reduction in that number down to $80,000, and I'm only taxing you on $80,000. Right? That's where our little reduction came. And this is a super powerful tool when it comes to tax savings. 20% off of your income. And the problem that I saw with this is that because it was new, not every tax preparer, CPA understood the flow of it. Okay? So I always suggest that people take a look at their 2018 tax return, if you're self-employed, and see if you have a deduction for the qualified business income. Okay, it's page 2. I can't remember exactly the line 10 or 12. Right in there, you'll see qualified business income deduction. See if there's a number there. If there's no number there, that means it wasn't marked for it, because you actually had to mark for it. This deduction happens in your personal tax return, even if your business is inside an LLC or an S corp.
Okay.
Yeah, so it's a little bit different. So CPAs had to go mark for it in your LLC or S corp, and then let that income flow back to your personal tax return, and that's where the deduction occurred.
Okay.
That's why I always say there are tons of people that missed it, right? Just because it was new. I mean, CPAs try to keep up with everything, but sometimes, there's so much, especially when big changes happen like this, that it can be easily missed, not marked for, whatever. But just go back and check. Take the 2 minutes to make sure you didn't overpay, because that could be worth thousands and thousands of dollars to you. As far as taxes go. The other thing, if you remember, I told you earlier that the IRS likes to use words.
Yeah.
Right? So, in this instance, they use qualified. Okay, so most people say qualified. Yeah, okay, qualified, so what? What does that even matter? Oh, it matters. Because qualified business income is income that is subject to self-employment taxes, which is largely Social Security, for the most part. Okay, so if I have income that's not subject to Social Security, does that still qualify for this deduction? Okay, so let's then move that premise into real estate. Rental real estate income. Okay, rental. So I go out, I buy an investment property, I make money off that investment property. That income comes to me as passive income.
Right.
Passive income, and the reason where I'll do investment properties is because it's cheap income.
Right.
No self-employment taxes, no Social Security taxes on that income, right? So the question then becomes, does rental real estate income qualify for this deduction, right? Because it's passive, it's not qualified. And the IRS came out and said, hey, we'll let you know.
Nice.
Yeah, we'll let you know. So I sat there and waited for we'll let you know. I waited the entire year. I even went through my training, and usually, so CPAs here, at least locally and where we are, have to do 40 hours a year of continued education work to keep your license, right? And I typically do all mine in November, after all my tax deadlines have passed.
Right.
And even in November, when I was going through that, asking the questions, hey, when's the IRS going to release this stuff? I'm going to start doing tax returns here in a couple months. I got to know, all my real estate people that qualify for this stuff. And we waited and waited. Year passed. Nothing happened. Not until the beginning of February, when I was actually doing tax returns, did they finally release something for passive real estate investors and this qualified business income deduction. And it was a safe harbor memorandum. Okay, so if you go in, you Google real estate safe harbor memorandum, IRS, it'll bring it up. So what they finally said is that for purposes, and only purposes for this deduction, okay, it does not transition you into being a real estate professional, right? If
Right.
all I own is real estate rentals.
Right.
So just for purposes of this deduction, you can qualify. If it is the IRS after all. So there's always an if, an asterisk.
Right.
If you meet certain qualifications. And then they go through and they list all the qualifications of that you have to have in order to deduct it. And the biggest one is hours. I think it's like 250 hours roughly that you need devoted to your rental real estate operations throughout the year.
That makes it not so passive.
Yeah, makes it not so passive. But honestly, I mean, when you're in the real estate game and you have, I mean, it's pretty easy to get a couple hours a week, right? 3-4 hours a week. That's not even an hour a day.
I'm always preaching this. Real estate's a business that you have to do at scale, and I think for real estate investors, you talked about how it's behavioral economics, right?
Yeah.
The rules around becoming the status of a real estate professional. There's some tax advantages to that.
There can be.
And so with rental properties, putting that much time into it is just. That's another reason to do it at scale, right?
Right.
It's riskier if you've only got 1 or 2 rental properties. You're not going to make as much money. It's not something you're going to be able to retire on. But if you can learn the skills, and we've got our other classes that go into detail about this, but if you can learn the skills to be able to go out and do this at scale, do 100 of them, do 200 of them, do 1,000 of them, right? Then you start being able to take advantage of some of those things.
Exactly. And then the thing, I may get 20% off of that income.
Yeah, exactly.
Right? So I would always...
A reward for doing it at scale.
Exactly. A reward for doing it at scale.
Yep.
So again, incentivizing you, right? Behavioral economics. Do it at scale. Own a bunch of properties, provide housing for a bunch of people.
Yep.
But sit down with your real estate or your CPA, your tax preparer, and see if you qualify. Go through these issues with them. Never leave money on the table. See if you qualify. It's a real important tool. So let's talk about home office deductions really quickly. I know people say, "Oh, that's an easy one." Well, it is kind of, but you have to understand some things when it comes to home office before you decide how to take it. Home office can be a super powerful deduction, honestly. And lots of people leave it off. One, they don't want to deal with it. They just think it's too complicated. It's not. Don't overcomplicate what a tax preparer should be doing from you. Just go in there and say, "Hey, I have a home office. Here it is. You deal with how to fill it out, the paperwork that's needed, right, to comply. Let your tax preparer do all that stuff." Right? That's what you pay him to do.
Yeah.
So, but you have to understand the difference of how I can take the home office. Okay, so we have our traditional method. Traditional method would state, okay, I look at the square footage of my home office, I look at the square footage of my total house, I get that ratio, let's say it's 10%, and then I look at all the costs of my house. Interest, real estate taxes, insurance, utilities, all those things. I lump them in. I take 10% of that. That gives me part of my deduction. Right. The other part is depreciation. Okay, so the traditional home office would force you then to convert part of your personal home to business use and depreciate it. Great from a tax standpoint because I get extra expense.
Yeah.
Right? So, but the difficulty comes in, what do you think happens when I sell my personal home?
You got to recapture all that.
Got to recapture all of that.
Yeah.
And typically people are like, ew, I've lived here 3 years.
Yeah.
I'm married, $500,000 tax free.
Yeah.
Right? Into my pocket. Well, not so fast. Now, if you've been taking the traditional method, all that depreciation gets recaptured and I owe tax.
Go into the mechanics a little bit more on that. I think there might be some students that this may be their first time hearing about depreciation and recapturing all that stuff.
Okay, perfect. So let's say let's make math easy for the accountant. So I have $1 million home, 10% is my home office. That ratio means it's $100,000. I paid $1 million for my house,
Right.
$100,000. So just like I would do with the rental property, I take that $100,000 and I depreciate it every year. And it gives me a number which I include as part of my home office deduction. So let's say, it's, $3,000, $2,700. So I'd live there, and I do it over 10 years. It goes into $30,000 or whatever it may be. And then I sell my house. All that $30,000 is now income to me.
Right.
Just like it would be if I sold a rental property.
Yep.
Right. So that's income to me. It goes in. Now I owe tax on that when I'm thinking I'm scot-free with the sale of my house. So the point of all of this is you have to be prepared and willing to accept the back end I call it a trap, but really it's the back end result of the traditional home office when I sell my house.
Right.
And so people say, "Oh, should I take it?" I say, "Well, let's talk about it. Do you need the deduction? Hey, it may be worth it to you. You may want that extra $5,000, $6,000, $7,000 as far as depreciation goes because you had a really good year." Or you say, "Man, I'm never selling my home. I'm dying here." Awesome, take it. Who cares, right? Take it. So there's circumstances that can be very beneficial. You just have to understand what happens when you sell your house. So the IRS decided, you know what, maybe that's too complicated. Maybe they wanted to give us something easier. Maybe people weren't taking depreciation or taking it wrong. And just a side note, if I can say this, if you forget to take depreciation and then you sell your house and you get audited, the IRS will go back and calculate the depreciation as if you had taken it and then tax you on it.
Yeah. I had no idea.
Oh, yeah.
Wow.
That's their compliance. It's compliance with the law. Anyway, so just be aware of it.
Yeah.
So the simplified home office is simply based on square footage. Hey, I'm going to give you $5 a square foot, up to 300 square feet. It's $1,500 deduction. You're not going to have any recapture. You don't have to list any utilities, nothing. Just a $1,500 deduction, which is awesome. So I think that's a great way to go if I don't want to have to deal with depreciation. So personally for me, that's the one I use. I don't want to deal with any recapture when I sell my house, flip it over, go to a new one. In the real estate game, when you start doing real estate, you like to kind of bounce sometimes, make gains, and dump those into, especially when it's your personal house, you can get stuff tax-free. So I take that one just because it's simpler and I don't want to deal with it.
Yeah.
Right?
What's interesting is with those types of things, the reason there's two of them, and this is my opinion, correct me if I'm off base here, but the nice thing is when you have options like this, you can decide what's better for your current situation. And that's why there's not really a blanket answer when it comes to real estate investing or taxes or legal. It really comes down to what are you trying to accomplish.
Yep.
Right. So you may be 1 year, going after that simplified home office deduction, but then the next year some things have changed and you've got other activities that are creating other taxable events or whatever the case might be. You may want to use, so understanding both sides of it is just going to put more weapons in your arsenal when it comes to creating a master tax strategy and a master investing strategy.
That's exactly right. So I'll give you one more example on that. Let's say I own my home. I've been using the simplified home office deduction. I sell my house. I have another house that's being built, and I know I got to rent for 2 years. Oh, rental is like the silver lining of the traditional home office. Yeah. Because I don't own it, which means I'm not depreciating anything. Right. So then I'm just looking at that. If we go back to that 10% example, 10% of my rent, 10% of my HOA, 10% of my utilities, right? That becomes my deduction. So if you're a renter, where your primary residence is a rental for you, traditional home office can be awesome. Real powerful tool under that circumstance, which then just emphasizes sit down with someone, go through it.
Yes.
What are you doing? What are you trying to accomplish? What's the best scenario here for you?
We talk about all the time in our other courses how important it is to use professionals. I think there's a huge pop culture movement right now of kind of the DIY movement, right?
Yeah.
Which makes it almost seem sexy to go out and just do everything yourself. Don't pay anybody to do anything. Just do it all yourself. And I refer to that as the employee mindset. Right,
that's exactly right.
If you're pinching pennies to try to save something, I had a mentor one time that put it best. He said, if you think it's expensive hiring a professional, try hiring an amateur. Right?
Yeah.
And I've learned that the hard way a couple of times where I thought, you know what, I'm going to save the $100 and I'm going to go do it myself, and then I mess it up and it cost me $500 to fix.
Right.
Right. It would have been so much cheaper for me just to hire a professional in the first place to take care of these things. And I think that's so true with taxes, especially if you're going to go out and start doing something on a grand scale like real estate investing. You don't want to be spending, hours and hours every day trying to figure out how, what kind of tax implications this is going to have. Hire a professional. He'll do it better than you, right?
Right.
And he's going to be able to kind of be there to clean up the pieces as you're blasting forward. That's the strategy that I've used and converted to over the last 7 years as a real estate investor, and it served me well.
Yeah, so let me ask you this question. How many flips do you think you've done?
Oh, probably in the 60s.
60s, yeah. Right? Let's say I've never done one.
Okay.
And I go in to do my first flip. Do you think you're going to know more than me?
Yeah.
Of course, right?
Yeah.
Because you've done 60 of them. I mean, that's a lot, right?
Yep.
And I've never done one. There's no way for me to know the tricks and traps and unforeseen things that I'm going to run into. So same would hold true for your tax return. You're going to do a tax return, what, once a year?
Yeah.
Do you know how many I see?
Right.
Thousands, right? So it's impossible for you to get up to the speed that I, run down because I see so many more. It's just, it's pretty simplistic, right?
Yeah.
So that's why professionals in areas, even well beyond tax, can be so beneficial to you succeeding in whatever is that you're doing.
Absolutely.
Okay, let's talk about my very favorite subject in the entire world, which would be automobiles. I'm an auto junkie. I love them to death. So, of course, I'm going to try to figure out how to write them off.
Right.
I often tell myself, let's say I made $1,000 per month, and that was my total income. I'm fairly certain 800 of that would go towards car payment. Right. I tell myself I'm an accountant. I can figure out how to live off of $200. I'm smart enough to do that. But that's kind of my love affair with automobiles.
I've got the same affliction.
Yeah. And most people know, hey, there's two ways to kind of write these things off. I just want to go over them with you because automobiles, especially in real estate or any industry affiliated with real estate, like contractors, woodworkers, finishers, all those guys, and I do a lot of their tax returns as well. This can be one of the most powerful tools that I kind of put in my back pocket and utilize in order to try to save you money. Okay, so quickly, the two different ways are actual and mileage method. Okay, and the actual is just like what it sounds. Okay, I'm going to depreciate the car or the truck, and then I'm going to look at all the costs surrounding what it took for you to utilize that truck, which would be gas, insurance, repairs, maintenance, new tires, smelly stuff to make your car smell good inside, those little pine tree things, right? Car washes, floor mats, accessories, all of it. So I'm going to look at all those costs. I'm going to bundle them up, and I'm going to look at your use of the car. Okay, so if you drove 5,000 miles for business, of a total of 10,000 miles of use for the car in the entire year, it's 50%. I'm going to get 50% of those costs. Okay, and that's going to be my deduction as far as auto goes.
Right.
The other way is the mileage method. Mileage method is much simpler. The IRS tries to put together a rate that encompasses all of those costs associated with the car. Like, what is the true cost of driving a car per mile? And they have to average it because they only put out one rate, and that could be averaged from the Prius that gets 50 miles to the gallon, to my, my GT 500 1968 Mustang that gets about 7 miles to the gallon. King of the road, right? So they take in that whole average, right, to come up with a rate. Currently, it's 58%, but it changes. It can change all the time, go up, go down. Whatever it is. So you look at that same example. I drove 5,000 miles of business, of 10,000 miles total. I'm going to take the IRS rate. I'm going to times it by the 5,000 miles. Boom, I'm done. Right? That's my mileage deduction. So which one is better? And in typical fashion, if you're dealing with a tax preparer and you ask him a question, his or her first response should be, well, it depends. It depends. It depends on everything.
Yeah.
What kind of car do you drive? How often do you use the car for business? Where are you going? Are you hauling stuff? Is it strictly a truck only for business? Are you driving, again, that Prius that gets 50 miles to the gallon? We've got to talk about it and see which one is actually best for you. Yeah. It's a big deal because, for example, in the real estate game, because I deal with a lot of contractors, you can do things with trucks, for example, but I can't necessarily do things with autos, right? Because of Section 179, which is accelerated depreciation. I can take the whole value of that truck and depreciate it off in 1 year. Right, so I stick those things in my pocket. In fact, just last week I was dealing with a contractor, bought an $81,000 truck last year, and we're looking at how to use that. So we put all of his information except for that truck inside his tax return, see where it came out, and then we started the discussions.
Yeah.
Okay, how do we want to use this truck? Is it best for me to put this truck in and now and get rid of all of your income? Because what else do you have going on in your life? Oh, I want to buy a house. Oh, well, you want to buy a house, it may be better not to increase your income a little bit because bankers don't like that, right? And go through that whole scenario.
And that's so strategic. And sorry to interrupt at this point, but that's so strategic because when I first started learning about taxes and tax deductions, and I kind of got on this high of, I'll take all the deductions and get my income down to zero, on paper so that I don't have to pay any tax. And I did that for a few years. and then tried to qualify for a house, and that was difficult because I didn't
Really
think
difficult.
ahead.
Yeah.
The banks are asking for your 1040s, right? Banks are asking for your tax returns. They want to see what you made, and if you took all these deductions and granted did it legally, morally, and ethically, but so you didn't have to pay any taxes, then that's going to affect you down the road with what
That's
your
right.
plans are.
With your plans. That's right. So in his particular case, we're going to safeguard that expense, right? Because he needs the income personally. So we safeguard the expense. We only take so much this year, and then I'm going to push it in the future years against his income, right? So that's how we're utilizing the truck for him personally. But it's so dependent on what you have going on, not just within your business, but you got to look at your personal life and what you're trying to do outside of it.
Yep.
And if I can give you a sneaky little trick for what you were just talking about, oftentimes financial institutions or loan officers, as they're going through and doing that whole thing, if you know you're going to be buying a house that next year personally, like your personal home, and you have losses because you're taking advantage of the tax code and what's afforded to you.
Yeah.
Think of that 1 year before you buy your house of issuing yourself a W-2 for stated income that 1 year.
There you go.
And that gets you out of all of those losses the previous year. So you can utilize W-2s. Again, so that's something you sit down with your tax person and say, hey, how do I do that? I need income at this level. Well, let's look at it. Maybe we can issue you a W-2 and go through that scenario, do it one time. Even if it's December, boom, we're going to pay you $80,000, W-2. Now you have your fixed income to go qualify the next year. So, some of those tips and tricks that you can do when it comes to taxes. But think about the use of your auto. Okay, think about the use of your auto. And if you're wondering what the IRS considers, I always like this question. What do you think the IRS considers a luxury car? Like, how much money do you think you have to spend on a car for them to say, you're driving a luxury vehicle?
Well, the IRS probably has a different opinion of that than I do. But
certainly. That's why it's a fun question.
Probably, my guess would be $50,000.
$50,000, $19,000.
Holy smokes!
Really? Yeah. So, which basically means everyone is driving a luxury car.
Yeah.
So I'd like to throw that out there.
New car at all.
Any new car, realistically, you're driving a luxury car. And I'd like to just throw that out there to put you in the mindset of what kind of how the IRS thinks, especially when it comes to vehicles. So we all drive luxury cars. It's awesome. Yeah. So $19,000. So just keep that in the back of your mind. Okay. So let's move on to this code section 162. This is kind of the bread and butter when it comes to writing off deductions, because it's what is ordinary and necessary. Again, we're dealing with words in the IRS and how they use them. So I'm always asking people.
A little bit ambiguous on purpose.
Completely on purpose. Because I'll say, what is a definition of ordinary and necessary? And no one can ever really give me one.
They'll let you know.
They'll let me know. Yeah, they'll tell you this is ordinary and necessary. I have a 9-year-old daughter who thinks it's only ordinary and necessary to shower twice a week. I completely disagree with that strategy. I do not think that is the definition of ordinary and necessary. And we argue about it. Right? So, which would hold true in the tax code. And what I hate for people to do is to say, hey, I'm going to have whatever definition for ordinary and necessary is going to be. And then you get audited and you have to sit down with an auditor, and that auditor is upset for whatever reason. Maybe his car broke down the day before, it has all his expenses and, his relationship isn't quite going where he wanted. And I say he, it could be he or she, but where he wants it to go. And then on the way to work, he stopped by Starbucks and they messed up his order. And now he has the wrong drink and he's upset. And then he sits down with you. And then you're trying to tell him what ordinary and necessary is that day. And he has, he's going to bring a lot of that baggage.
You got a chip on his shoulder.
When you're talking about ordinary and necessary.
Right.
So really, I would say when it comes to this code section, just think about what it took for you to make $1. Like all those expenses. Look at your bank statements, your credit card statements. If you utilized cash, what actually went in for you to make $1 and then support it?
Yeah.
And keep the support for all those expenses. It is your support that's going to drive up your ability to argue ordinary and necessary.
And I think this is why, and maybe there's more reasons that you can go into, but I think this is why we're always told, keep your receipts. Keep your receipts, file your receipts. We were talking about the vehicle deductions, mileage, record your mileage.
Yep.
Those things are important for this reason, because then this is data that you can support that with. But, maybe you can go into some detail about...
Yeah, for example, if I have to argue, if we get an IRS letter in our office, it's going to come over to my desk. for a couple of reasons. One, honestly, I like to fight.
Yeah.
Let's be honest.
I love it.
Okay, I like to fight with the IRS. I do get a certain amount of weird kind of, joy in beating them or convincing them or whatever you want to, or creating a case or an argument case. There's a certain amount of joy I get within that. So I'm gonna look at kind of what's happening, and then I'm gonna go back to the person and say, okay, give me your documentation on what you submitted and what we went through that went into your tax return. And if they can't, it handcuffs me completely. There are certain things I can try to do, like I've dealt with when people had about maybe 70% of their receipts, and then I'm making a case for the other 30. Through maybe just a credit card statement, for example, or, just showing patterns. But then it becomes an argument, right? And then I'm just arguing, right? Of why that other 30% should be allowed. Yeah. But what would allow it is if you had the receipt for the deduction. Yeah. And so since we're bringing up this talk, let me ask you this question. What do you think the IRS's stance is on just a credit card statement? Like, is my credit card statement ample support for my tax deduction? Because the credit card statement is awesome. People love to use them. I love to use them, right? They're laid out nice and pretty. They have the date, the time frame. February 1st, Walmart, $325. Awesome, right? Laid out right there for me. So I show that to the IRS. Do you think that's support?
Knowing the IRS, probably not.
Probably not.
Enough.
And let me tell you the reason why. Because nowadays we have these big box retailers that are multifaceted. Yeah. I can go to Walmart, I can buy $300 worth of bananas, milk, and underwear. Yeah. Or I can go there and buy 2 computer monitors for my business. The credit card statement doesn't tell me which one I did. Yeah. The only thing that does is my receipt. That's the only thing that does is my receipt. It itemizes what I bought. So the receipt is necessary. The problem with receipts is they fade. Like if you live in Texas or Florida, middle of summer, you have the receipt, you just throw it in your cup holder, and then you leave the car. It's like 120 degrees in that thing. Yeah. You come back a half hour later, that receipt is gone. Yeah. It is blank. It's like, what was this? I don't need this anymore. Crumple up, throw it in the trash, right? So that's the problem. So we've got to be more diligent than just using credit card statements. And there are tons of tools that allow you to do it. Even the credit card companies themselves have gotten smart. So the credit card that I use, they actually have an app that will put that expense in and let me take a picture and attach it to that expense immediately. Like when I say immediately, I mean I swipe, they give me the receipt, I open the app, it's there, I take a picture, boom, I'm done. And they're even smart enough to know, hey, we're going to keep that for you for 7 years. Yeah. Right?
That's awesome.
So utilize technology. Does a picture of a receipt, is that good enough support? Absolutely. Yeah. Can I PDF these things, throw them through a scanner? Absolutely. Right? So just be smart on how you do it. Create a system that works for you. But just know that if I want to support my particular tax return, I'm going to need the documentation to do it.
Right. What about things like QuickBooks, for example? If you do your bookkeeping on QuickBooks and you're putting in the transactions and you're making a note of what those transactions are for, categorizing them, and then have your profit and loss statements or whatever other types of reports that QuickBooks or alike software can export, is that going to be something that would back up your position with the IRS, or you still need the receipts in addition to that?
Okay, so first of all, if you come in, you're a new client, you sit down and you say, oh, I got everything on QuickBooks. First of all, you're my favorite client. Oh, you're already like A+, right? Because you've taken the time and kind of the energy to look at your operations and document what you're doing. And I mean, we can go into some of this stuff a little bit later as well. But yeah, the QuickBooks will lay out how maybe the numbers that I work with when it comes to your tax return, but it doesn't negate the fact that you still need the receipt to back up what's in QuickBooks. Yeah.
The itemized receipt.
That's right.
Because then it shows whether it was underwear or a computer monitor.
Because I'm an accountant, and quite frankly, I can go into your QuickBooks file and, I can get rid of income pretty quickly, right? Just by, little finger magic. Right. But yeah, so we will still need the receipt even under those circumstances. Okay. So that's why I always say, no one wants to keep a bunch of paper, especially nowadays. Everything's electronic. Use the electronic tools that are available to you. Yeah. Get rid of that stuff, scan them, do something, because you really only need the receipt in the event of audit. right? We can work with your QuickBooks, and we will. But under audit, then I'll say, hey, let's go back to your receipts and let's pull those up.
And I've made a habit of, most of the time when you're buying something, at least I think it's getting less and less this way, but most of the time when you're buying something, you're in your car, right? Driven somewhere. So I've made it a habit of when I buy something, whether it's a convenience store or a big box store or whatever the case might be, when I get back to my car, I get in, put on my seatbelt, pull out my phone, scan the receipt, put the car into drive and head off. Right?
Perfect.
And then you can just throw the receipt away.
Throw it right away.
Home or whatever, but just making a habit, and we've got a whole class on mindset and creating those habits that set you up for success. That's absolutely a habit that's going to set you up for success when it comes to keeping your wealth, and specifically tax strategies, is get in the habit of documenting stuff.
Right.
Get in the habit of, if it just takes an extra little motion of pulling out your phone after you're at a store, scanning the receipt, we're talking 10, 15 seconds, right? It's worth that extra time that you're going to take every single time you do that, versus the cost that it's going to be if you get into an audit situation and don't have any receipts.
Right. And we can even take that one step further. So I'm an accountant. Obviously, I love numbers. I love financial statements. I love income statements. Why? Because they tell me so much. I sit down with clients and they produce all their documentation and stuff to me, and I'm like, oh yeah, I get a good sense of who you are and kind of how you live your life and all kind of different aspects about you. They tell me a great story about kind of how you act and so forth,
Right.
So I love that stuff, as well as it allows you to know how much you've spent, where your financial position is, and then what kind of decisions can I make from an operational standpoint moving forward. So if I'm doing flips, for example, and I have all my numbers in line, I know how much money I made off of a specific one, that's going to help me adjust maybe my mindset as I go into my next possible deal to what did I do in the last one? And what is my buying power? What can I actually go in? Where are my credit card statements at? Like what is available to me? How much money can I put down? I mean, it goes into your financial decision-making process, because you wouldn't think it, but from my standpoint, keeping receipts, keeping your books up to date just lends itself to your ability to make proper financial decisions moving forward.
Absolutely. And you brought up a great point. It gives you the data to look back at to make better decisions in the future. One of my a close personal friend of mine, also a mentor, very wealthy individual, makes a lot of money every year. But he told me one time, he said, the difference between someone who makes 6 and 7 figures a year is the people who make 7 figures a year know their numbers.
Well,
that was
good.
interesting to me, because I'm not a numbers guy. I'm not I've had to force myself into the systems with real estate. I mean, real estate investing is all based on numbers. I've had to force myself into that system. That's just my personality, right? So when it comes to knowing my numbers and referring back to my QuickBooks reports and making plans and goals based off of numbers, that's been a real shift for me. But to hear someone say, hey, look, the difference between making 6 figures and making 7 figures is knowing your numbers, and that's the key thing. That's enough motivation for me to say, hey, I want to get to that next level. Let's base our decisions off of the math.
Oh yeah,
right?
I love that. As an accountant, I mean, that's awesome.
Yeah.
Okay, so let's move on a little bit to real estate taxation. I want to talk just really quickly about this. And I want people to understand that there are differences. Okay, we have the for rent side, and that's my investor side. I mean, oftentimes when you tell someone, hey, I'm in real estate, their mind kind of goes to the rental side. Oh, you own rental properties.
Or agent.
Or an
I get
agent.
that a lot.
Right.
Oh, you're
One
a
of
real
those
estate
two.
agent.
Right?
No,
I just own rentals.
I'm an investor.
I'm an investor. So that's the investor side. Okay, we call them investors. Some things associated with the investor side is when I sell a property, it's capital gains based on how long I held it. The income I make is passive, no Social Security taxes. I can 1031 exchange, for example, into another rental property. And I utilize the kind of code section that deals with the investors under that scenario. The other side, the for sale side, is the flipper side. Okay, we refer to those as dealers. So it's the dealer side. I have the investor side, I have the dealer side. The dealer is the flipper. That is treated as a normal business. Think of it almost in terms of a retail business. If I'm a flipper, my property that I buy is actually considered inventory.
Product.
It's a product,
Yeah.
right? I'm putting money into that product, just like I would if I was manufacturing something. And then when I sell that product, I associate all my expenses with that product against the revenue that I make when I sell it, right? It's ordinary income. I have to pay Social Security tax on that income.
Yeah.
I cannot 1031 exchange. It's not capital gains, right? So it is treated like an ordinary, I like to think of it as a retail product-based business.
Yeah.
And so people have to understand, okay, what am I doing?
Yeah.
And which avenue or which path am I going to walk down on this specific property? Because I want you to separate them and I'm talking even strictly from tax. I know there are lots of legal ramifications of that too. I won't go into those, but even from a tax perspective, I want to present to the IRS what it is that you are doing. I don't want the IRS to come back to me and say, I'm going to classify you as, I don't know, a dealer, because it makes more sense from my perspective and I can tax you more. Right? I want to present things in a way to the IRS that says, hey, under this company, for example, is where I'm holding all of my rental real estate. Maybe I have them in single member LLCs or however I do them. Right? But this is all my rentals. This company over here does all my flips. Right? And it's an active income generator for me. And that's where all of those operations occur. So I want to be able to separate them. And in my mind, I want to be able to tell the IRS, this is what I'm doing. I don't want them to define it to me. So I just want people to understand there are two different paths you can walk on in real estate. Know which path you're walking on.
Yep.
Then let me give you one more little example if I can.
Real quick before we move on. So the way that we've structured is we've almost got like a business structure for short-term income and a business structure for long-term income. My short-term income, my flips, my wholesales, things that happen within the space of a year, that's all structured under an S corp. And this is a good example of how there's not kind of one, hey, if you're going to invest, you need LLCs. That's not necessarily true. There's a protection side from the legal standpoint,
Correct.
but there's also a tax side that you have to
Correct.
look at. And for that tax reason, I was told S corp is what you
S
need.
corp for those
flips,
are great.
And LLC that's taxed as a sole proprietorship or a partnership for your long-term stuff because of the tax advantages from each
Correct. That is a great structure from a tax standpoint. I would never advise someone to hold rental real estate within an S corp. LLCs are they're simpler. They allow for movement.
Right.
Oftentimes we're buying rental real estate in our own name, and then maybe we quick claim deed it over to an LLC or something. Right. S corps have different rules because really you're a corporation. You're just being taxed under a subsection of the corporation rules. And what happens is when we move an asset inside of an S corp, we have to look at its value. And real estate appreciates. I mean, that's part of the reason we buy it. That's part of how we calculate our gain and how much money we're going to make. But if I have to transfer that back out of an S corp, let's say I need to refinance it personally or do something like that, if that asset has appreciated, we have built-in gains by moving it out, and I owe tax, even though I never sold it. So just from a tax standpoint, the structure you said works perfectly. Keep my rentals and LLCs, keep my short-term gains, my operational aspect stuff in S corps. I can do things within S corps with payroll and different ways of trying to minimize taxes, but that's a great structure to use. It's a great structure to use. So let me just real quickly tell you about a tax court case, if I can, before you think you're maybe totally bored. It's a good one, and it involves FedEx, of all things. FedEx, right? The delivery company.
Yeah.
So FedEx and the IRS got into a little tuffle, right? A few years back, they got a little mad at each other, and it was over a specific issue dealing with repairs and maintenance. So what FedEx would do is they have a fleet of planes, right? Because they're transporting packages all over the world. The plane runs off of hours. Okay, much like a boat. Maybe if you have a boat, you track its hours.
Right.
And when the hours hit a certain threshold, then it goes in for routine maintenance. Okay, so the engines is mostly what we're talking about. So they hit the hour threshold. FedEx would take that plane into a hangar. It would drop the engines off the plane. Okay, set them aside. Put replacement engines back on that plane and push it right back out. The problem is because FedEx knows if that plane's not flying, FedEx isn't making money. Right. So they would service the engines, and when the service was done, the plane would come back. They'd swap engines again, and they would get pushed back out until its next hour requirement to come back in for some routine maintenance.
So just rotating a set of engines.
So that the issue came over those second set of engines. because FedEx was saying, hey, that's part of my maintenance, right? Repairs and maintenance. I'm just expensing that off, the cost of all those engines. And the IRS came in and said, hey, wait a minute. That's an asset, man. Okay, you got to capitalize that thing and depreciate it over time. And if they depreciated that cost over time, what happened with FedEx? It would increase their income. They'd owe a bunch in tax, right? To the tune of tens upon tens of millions of dollars in tax. And that's why they went to court. So they go in, they fight over it. And in the end, you would say, oh, yeah, the IRS won. They didn't. FedEx won. Okay, FedEx won. The IRS got mad. So what did the IRS do? Change the rules. A year later, they changed the rules on repairs and maintenance. Okay, as a result of this FedEx case.
Wow.
And what came out of it is this term betterments. I don't know if you've heard the term betterments. So betterments involves repairs and maintenance. And why do I care about some FedEx case and betterments when it comes to my rental real estate? Well, rental real estate every year has what? Repairs and maintenance, right? So this betterment issue comes up for us real estate owners, especially the rental side. Again, much like ordinary and necessary, betterments, I mean, what's better? I just put in a dimmer switch.
Right.
Is that better?
Yeah.
Right? I changed the handles on that door. Is that better? I guess that's a form of interpretation.
Yeah.
Right? But we have to be cognizant of this betterment issue. So the IRS has kind of given some generalities. Have you changed its function? Have you made something larger? Have you increased its life? Have you, and they kind of give these generalities, but we have to be aware of it when it comes to our repairs and maintenance costs. So I would always tell someone, take all your repairs and maintenance, sit down with a CPA, go over the betterment issue, see what I may have to capitalize and expense over time. What do I want to try to push through this year? Are there certain things that I can do to help with that? There's from a CPA, there are de minimis rules and de minimis selections that I can do to increase your repairs and maintenance. So it really helps to sit down with someone who knows a little bit about real estate taxation to try to push that repairs and maintenance up as high as possible, if not to everything, because that benefits you as a taxpayer, right?
I'm going to jump in on something you just said, because I think it's so important. It just popped in my head because of the way you said that. Sit down with a CPA that's familiar with real estate. Mm-hmm. That not all CPAs are created equal.
Yeah, I always like to term it as an exposure issue.
Yeah.
Right? Because if I'm if a CPA builds his practice on maybe earned income credits, which some people do, don't really want to deal with business. Yeah. Therefore, they don't know much about rental real estate, which means they may be missing all kinds of things that they could do or couldn't do. Have no idea about maybe the safe harbor rule with the 20% deduction or de minimis rules when it comes to repairs and maintenance and all these types of things. So it does lend itself well if you sit down with someone who has at least a background. And because I do real estate myself, I'm always going to be looking for those things, right? So it is really kind of a big deal to sit down with someone in your industry. Yeah.
The tax codes and the laws are robust enough in this country that when it comes to CPAs and attorneys, you have specialists. You don't have just one guy that you can go to at H&R Block that's supposed to know everything.
Right.
You need to find a specialist. And so if you're running a business that specializes in a certain niche area, you should probably find a CPA that specializes in that niche area.
Exactly.
Right? And it's the same with real estate. You want to be working with attorneys and with accountants that understand the real estate game, because just like you said earlier, you see hundreds of returns a year, and if your specialty's in real estate, then you're seeing all of the different strategies that people are using and all of those different things, and you can help the next individual customer or the next individual client so much better because of that experience than somebody who just sees W-2s.
Right, that's exactly right. Are you implementing like cost segregation studies? What is your property cost? All these kinds of things. Yeah, it goes a long way to try to give you, I guess, the best product or service possible to really put as much money back in your pocket as we can.
Yeah,
absolutely. Okay, so let's talk about my role as a CPA. When I like to say you be you and I'll be me. Let me tell you what I mean by this. So back in the late 90s, I know it's been a while since then, but I don't know if you can relate to this. You probably can. You're too young. But But back then, accountants, or at least me, thought, I'm going to build my computer. This was the building of computers era,
Right.
right? I'm going to order my specific components. I'm going to build my own computer. I don't need Dell, to do it. I'm going to save, $400. And that's what I'm going to do. The DIY movement, even back then, right?
Yeah.
That's what I'm going to do. And that's what I did. And then as we kind of moved things along and hired people and kind of did that, we're building more and more computers, which led us to build our own network, which led us to building our own phone system, interplaying with all that, which led a horrific foray into trying to do a website, and it got me out of the things that I really know and trying to do different things in different aspects of the company, maybe that I wasn't as familiar with, but thought I could do it myself. So what would happen is we'd go in the busy season and when it's just a frantic pace, right? Frantic pace. And let's say a computer goes down. Well, who are they going to call to come fix that computer? I don't have time to come fix it, but I got to go fix it. So, I may spend hours trying to figure out what's going on with all of this stuff. And if I'm spending hours trying to fix a computer, what am I not doing? I'm not doing tax returns for my clients, which means I'm not making money, right? So it ended up just costing a fortune thinking we're saving money when actually we were spending money and spending hours not earning money, which was, it's like an opportunity cost, right? That I'm going through that just turned out to be a horrible thing. So what we decided is, let's stay true to what we know, right? Let me be me. Let me spend hours in the tax code. Let me spend hours dealing with the IRS, doing tax returns, right? And then I'm going to have other people. I have an IT company that deals with all my IT stuff. Phone company deals with them. Website guys deal with my website. Legal guys deal with my legal stuff. Frees me up completely to do what it is that I do and I do best, which is tax returns, tax planning. So I would always suggest go out and do your real estate stuff. Don't spend hours and hours trying to get familiar with this subsection of Section 162. Yeah. Leave that to me, right? Leave that to me. You do you. You go make money. Let me be me and let me try to save you as much money as possible. That's a really kind of strong message I'd like to send, to anyone watching this as well.
That's so important. There's a philosophy out there that people spend so much time trying to figure out how to save money. And the problem with doing something like your taxes yourself is you're only saving what you would pay that professional.
Right, that's it.
So in things like real estate investing, we talk about this a lot in the Fix and Flip course. If you're going to not hire a painter because you want to save that $20 an hour or $25 an hour, that's all you're paying yourself to go out and paint that. But if you looked at what am I making when I go find the properties, when I fund the properties, negotiate the properties, actually do the investor side of investing rather than doing the contractor side of what people think investing is, right? You're going to make so much more money focusing on those activities. Focus more time on making money than trying to save money, because making money will always solve the problems better than trying to scrimp and save. And
Exactly right. That's perfect. That's
go out
a
and make
perfect
more money.
analogy. Go out and make more money. So let's talk about your partner, the IRS, right? Uncle Sam. Everything that you do. So a few years back, the IRS actually shut down. Most people don't know that, but they shut down, meaning they shut down to me as a tax practitioner. I couldn't submit any tax returns. It was at the end of the year. Deadline had passed.
Relationship thing. You're dead.
I know you are dead to me. I was dead to them for about 3 months, and then they opened back up. But what was really happening is they were updating software, hardware, all these things. The reason being is it was just simply becoming too expensive to audit, right? So that again, $11.1 billion half spent on enforcement, but the amount of money that they need to collect goes up and up and up. But their budget seems to go down and down and down. It used to be almost $12 billion. Now it's down to $11 billion. It goes down. So they've got to come up with smarter ways to collect money, more efficient. And face-to-face is just really, really costly. So what they came up with was this letter audit. And we're seeing those now. About 70, a couple years ago, it was up to about 71% of all audits are now done by letter. It's going to creep up and up and up, where face-to-face audits are going to be fewer, and they're just going to be mailing these letters out instead. Because the system matches up a bunch of stuff. They know all kinds of stuff about you, right? Your employer sends in what you make. Yeah. The financial institution sends in what you paid in interest, and oftentimes 1098's real estate taxes are there as well. You go into the stock market, make a bunch of money, right? Barter
know.
statement, boom,
Yeah.
IRS. You go and sell a bunch of products on eBay, boom, 1099K goes to the IRS. So they know what you sold on eBay. You know, oftentimes they're issuing 1099Ss for when you sell a home, and that stuff goes in. They have all kinds of information on you. And the system then is set up in a way that they will start matching all that stuff.
Yeah.
And any discrepancy that they see, boom, triggers a letter, right? Or they set things up for outliers or word terms. So if they say, oh, let me ask you this. Let me put it this way. Do you ever wonder why you have to put your occupation on a tax return? And what does it really matter? They know what you made if you're a W-2 employee. Who cares what your occupation is?
Yeah.
Why? It's data, right? So if I know what all the physicians make,
Yeah.
I can start to look at outliers. If I can find outliers, oh, guess what I think you're doing, right? Monkeying something up. So that's why you put your occupation, so you can be categorized. So I always tell people, man, don't make their job any easier.
Right.
Look at your occupation. You think I put CPA as my occupation? Are you crazy? I put manager.
I love it.
You know, put administration or sales. You know, something so nondescript that they can't. They have a harder time kind of lumping you into people, or into groups. But that's what they're doing. They're trying to figure out who can they send information to. Or they'll look at your, like if you have a Schedule C and you have all these expenses or 3 expenses that are huge dollar amounts, they may say, hey, send us some information on that. But this is how they're doing it now, is with these letter audits. Again, that's not to make people nervous that they're going to be audited. I mean, we all have the same, you know, we all have that chance, right? But it's to say, this is how they're doing it now. It's much easier for them, because if you get a bill that says, hey, you owe $800, what are you going to do? You're just going to scratch a check because you want the monkey off your back. It's human nature. Right. Behavioral economics again.
Yep.
And they're utilizing that strategy here to collect more money.
Yeah.
And they're using it for interest penalties. We're seeing all kinds of things come out now where they're just sending these little bills, $300, $400, $500, which is adding up to billions of dollars being collected through these letter audits. If you ever get one, I would suggest you don't simply just pay it to get the monkey off your back. I would go back to whoever prepared your tax return and really take a look to see if you owe it.
Right.
Okay? Because you may not.
Right.
You may not. So who do you think they want to audit? Who do you think they're looking at? For the most part.
Small business owners.
Small business owners. Why? Again, they get all this documentation on us, but what do they not get? They don't get my revenue. Like, you paid me, you're not going to go report me to the IRS. I mean, maybe a 1099 you may, but
Sure.
But for the most part, people aren't reporting that. I go spend money at Walmart or, you know, or Best Buy or on Amazon for my business or whatever it is. You know, they're not necessarily reporting that to the IRS. So it's up to me to tell the IRS, hey, this is the money I made, and these are my deductions, and this is the tax I owe to you, right? They're not a very trustworthy group, shall we say. So they like to look at those self-employed people because there are dollars there, right? For self-employment tax being at 15% plus your income tax, right, being whatever it is, 20% or, you know, depending on how much money you make. So they're looking at ways of trying to collect those dollars, and they do it with the people that are self-employed. Okay, so I like to say, what's my way around that? Is there any type of insurance that I can do that may reduce my chances to be audited? Okay, so I told you that I like to look at the letters, right? So I've looked at them. Okay, so most letters that have come through my office over the last, we'll say 10 years, okay, I've seen them. So out of all those letters, well, they're not, you know, our client base is large enough that by statistics speaking, I'm going to see them every year, right? So out of all those letters that I've seen, how many of them do you think are addressed to an individual? Okay, so Joel Jensen, here's your IRS letter, versus all companies combined, meaning my 1065 LLC or partnership filers, my S corporation filers, or my C corporation filers.
My guess is the businesses would have.
Businesses would have most, right? That would be my assumption too. However, 100% of them have been addressed to individuals.
Really?
Every single one. I have yet to see anything addressed to a company. I haven't seen it.
Huh.
I Google search it too, just to see if,
Yeah.
you know, someone, I don't know why you'd put that online, but I like to check
Yeah,
anyway.
yeah.
But I haven't seen it yet. I haven't seen an audit letter in this fashion now since they've changed things being addressed to a business. So what does that tell me as a practitioner? So that tells me if I want to help protect you against IRS audit, the very first thing I'm going to tell you to do is go create a company. Go create an entity. You want some audit protection? Get that thing out of your personal tax return. Go create an entity, right? Because then I know also in the back of my mind, that gives me some leeway when I'm trying to define ordinary and necessary and going through the application of all these tax code sections into your tax return, right? I don't care if you're selling lemonade on the corner. Create a company. Create an entity.
Yeah.
Do it, because I know that's gonna reduce substantially your risk.
And when you say entity, we're obviously talking about LLCs, S corps, C corps, etc. Sole proprietorships and general partnerships would.
So general partnerships
fall
would.
more to the individual.
Sole proprietor would fall to the individual.
Okay.
Yep. But general partnership would fall to on the business side. Yeah. So I always just want to say, if you have the wherewithal, depending on relationships and all those kinds of things, it is a great audit defense strategy. The simple, and they don't cost that much, and they do not cost that much. It is well worth your time to do it. So this is an audit letter. Okay. We had a couple that called us and they said, listen, we have a real problem. We want to come in and speak with you. We just got an audit letter from the IRS. They are saying, if you look at the bottom right, we owe $62,000.
Yay.
Which is going to ruin their day. It's going to ruin my day, right? To bring in something like this. And the funny thing is that these audit letters are staged. Okay, so you'll get a first one. You're going to walk out to your mailbox. You see that logo, IRS logo on an envelope. You mutter very colorful words at first. And then you come in and you tell yourself, man, I'm not going to open this thing up. I'm going to throw it in a drawer because it's a Friday and I don't want to ruin my weekend. Right. I got all these plans. I'll come back to it the first of the week, and you forget about it because you don't want to deal with it. The next letter that comes out, it probably comes out maybe 90 days later. And in big fonts, if you were to open it, it says notice to levy, okay, on the letter, because you've ignored them so far. The notice to levy is a form of behavioralism because they want you to interact with them. They're not levying a single thing off of that second letter. They're not. The case hasn't been closed. They're not levying anything. It's a scare tactic to get you to move, to get you to communicate, right? Either pay them or at least communicate or send them something in that would tell them otherwise.
Yeah.
Okay. But oftentimes what happens is they grab that letter and they throw it in right by the first letter because it's a Monday and they have a whole work week ahead of them that they don't want to get distracted by some IRS notice.
Yeah.
Okay. It's the third letter we have to worry about because underneath your name, super small letters, it would say notice of deficiency. And that's what we care about, the notice of deficiency. Because the notice of deficiency puts you on a time clock. You now have 90 days from the date of that notice to either clear it up with the IRS or go to tax court, or you will owe it forever.
Wow.
Forever. There's nothing I can do about it.
There's no
that's it.
Statute of
You're
limitations
done.
on it. Wow.
No, you're done.
Jeez.
I mean, sometimes they say a statute of limitations on a collection. They go through, you'll read stuff of that online.
Yeah.
And they'll say, I can't remember the number of years it is. If you wait the 15 years, or I can't exactly remember that.
It's 10.
Then
I'm sad that
it's
I know
10.
that right now.
Oh, no, it's 10. I don't have to collect that anymore, right?
Yeah.
Oh, they can't collect me. Man, you think they're going to let you off the hook that easy? First of all, they will simply re-look at your file, reopen it, and boom, add on another 10 years. Mm-hmm. Or they will come and make it immediately due, for you right at that moment. Boom, that negates it as well. That 10-year is a fallacy if you believe that the IRS is going to go away. Right. They're not. Okay, so don't use that as your defense mechanism.
Right. If I can push them out 10 years,
that's going to just create more problems for
money.
yourself. Yeah. But that letter of deficiency is what we have to worry about. And people also get nervous about tax court. I love tax court. I think it's great. It's small tax court for most of the people I deal with. It's a $60 filing. And what it does is it actually assigns me a person now that I can communicate with, email with, have phone conversations with, and we can clear it up. So never be afraid of tax court or anything. Oh, my deadline's about to pass. Yeah. I don't want to go to tax court. Man, let your CPA do that. $60 and then he'll deal with it. Right? So going back to this letter, the funny thing is when we sat down, we started looking at this, trying to figure out, okay, what's going on, what wasn't reported. here's the thing that we noticed, and then we just kind of sat back. I mean, just a wave of relief washed over myself, so knowing that this person is totally fine. So if you look at this second line right here under Schedule D, capital gains and dividends, what do you think the tax is on a $481,000 loss? Zero.
Yeah.
What do you think your tax is on a $245,000 loss again? Zero again.
Yeah.
But if you go to fifth grade math, two negatives make a positive, and it's simply the computer system saying, oh, a reduction in loss creates $236,000 worth of income, flows that sucker all the way down, and you owe him 62 grand. See how that works?
Yeah.
It's a math mistake, essentially. Right. There wasn't a single person that looked at this letter. It was all based off of the computer system doing it, sending it out.
Yeah.
Now, had they waited until that letter of deficiency came, even based off a computer error, boom, they owe 62 grand.
Nothing
because it's compliance,
yeah.
right? We have to comply with the law. So I'd always say, as bad as it may seem to get those letters, open
because
them
of
up.
a computer bug.
Because of a computer bug, they would have owed it. Yeah.
Wow.
So this was a quick clear up with the IRS, and they didn't owe it or have to pay anything. But you just have to be aware that when you get these letters,
address it.
Take
action.
It doesn't mean you owe it. Go through it. But you have to take action. Yeah, don't ignore it.
That's such a common theme in everything that I teach. Is where people fail is when they fail to take action. I had a mentor tell me one time, and this gets a little bit bigger than what we're talking about now, but I had a mentor tell me one time. So this guy was a billionaire. He helped create some technology that moves cell phones from an analog cell to a digital cell. Sold that company in the late 90s, and a lot of money. So I asked him one time, I was probably 19, 20. I said, "What would you say is the a major key point that you could tell me that contributed to your success?" And he said, what's interesting is I've learned to not be afraid to fail. I'm standing on a mountain of my failures, and my mountain just happens to be a whole lot taller than everybody else's. Failure comes from not taking action. If you're taking action and you do it wrong, that's so much better than just not doing anything at all. And I think this is a perfect example of that. Even if you go about this and you start doing it and you do it wrong and you need to go back and do it over again, that's so much better just to open that line of communication than to just do nothing. And then all of a sudden, in this case, they would owe 60.
Yeah,
60
you're gonna let yourself be a victim of circumstance.
Yeah,
right.
Exactly.
Yeah, so let's not be the victim, especially when it comes to our IRS letters.
Yep.
So the financial accounting trail is something that we utilize when it comes to actually the completion of your tax return. We want to be able to, this goes in line with documentation that we kind of addressed a little bit earlier. But if you were to say, hey, I spent $5,000 on my office, so I have office expenses of $5,000, and I go into your tax return, I say, okay, office expenses in the right place within your tax return schedules, $5,000 deduction. I want to be able to say, okay, show me all the receipts that went into that $5,000, right? That'd be the one side. Or if I were to look at all of your receipts that totaled them $5,000, I want to go say, okay, where was that inside your tax return? So I want to be able to go from tax return to receipts or from receipts to tax return. That's what we call kind of the yellow brick road of accounting. It's the way we kind of set up our bookkeeping structure. Because I can't do your bookkeeping for you. Well, unless you pay me. But realistically, I can't do your bookkeeping for you, right? You come in, we have tax planning meetings and consultations, but that kind of, that is required of you and required of you to be in business. Right? We want to, if we're in business, we got to act like we're in business. Right. And part of that responsibility then is taking care of my finances, and which then, in my particular case, go into your tax return and involves with our tax planning. So we just got to be aware of that. We got to keep proper records, keep proper documentation that then allows me to do a proper tax return. Garbage in, garbage out, right? We say, if you give me garbage, your tax return is going to be garbage. I mean, I've actually had someone send me a FedEx box full of receipts. And this was not a small box. Said, hey, Joel, I'm sending you all my tax stuff. Awesome. Look at it. And it was just stuffed. I mean, stuffed with receipts. So I immediately said, return to sender. Boom. Send that sucker right back. Right? Because that tells me, one, you're not really that serious about what you're doing. You're just going to send me a bunch of receipts. How are you even operating? How are you making decisions when it comes to your business? When you decide that this is going to be my mode of operation.
Yep.
I mean, right? So just be aware of this. Let's take responsibility of our financial.
Yeah. Knowing your numbers is
knowing my
a
numbers.
practice.
So let's look at then if I'm in business, I'm taking care of my financial numbers. We look at the difference between a business and a hobby. And anyone listening to this, know that you are in business. Okay, you are in business. You are not a hobby. Okay, the real difference between business and hobby is my profit motive. That's really what the difference is. If I'm in business, it allows me to go negative. I can record a loss, which therefore allows me to offset W-2 income or capital gains income, right? Dividends, interest, all those things. I can lower my taxable income. If I am a hobby, I can only go to zero. That's it. I can never go negative. Okay? So the profit motive and pushing myself to the business realm is super, super important, especially from a tax completion standpoint. So if you were to ever ask me, hey, break it down even kind of more narrow for what is a business, these are the things I would look at that I have listed here. And it largely, as you can go through these, it's how do you act? Okay, if I'm a business owner and I'm doing real estate, there's a mannerism, right, that I'm going to undertake in order to maybe go find a rental property or even a fix and flip. If I'm going to go out and look for a rental property, I'm going to start contacting agents, right? And I know I'm going to buy one, so I'm going to get my finances kind of in a row. I'm going to meet with maybe some financial institutions to see what my borrowing power is. I'm going to look at maybe some general contractors to see, hey, if I got to fix stuff up, what's your availability? We, have an idea of costs and those types of things. I mean, there's a mannerism to how I'm going to act. Why? Because I have a profit motive behind me, right? The hobbyist doesn't have any of those things.
Right.
He's just like, whatever, man. It's all good.
Kind
of the surfer attitude, It's all fine. If I make money, great. If I don't, it was fun anyway.
Yeah.
But it's your kind of mode of operandi, shall we say, to what defines you as either a business or a hobby. So if you were to be audited, for example, and I was defending you, I would look at, hey, describe to me, how do you operate? What are the things that you are doing? Because I'm laying out a foundational work to defend you to the IRS. Say, listen, man. He's a business. Look at how he operates. Look at what he's doing every day. Look at how many hours he puts in. Look at how he's spending his money. Look at how he's educating himself and what he's doing. And look at the professionals he's hiring. Yeah. All those things go into me being a business and not a hobby, which then affords me greater birth, right, of being able to deduct what, tax deductions and trying to save money.
Yeah, absolutely. And it kind of ties back into something we brought up a couple of times, and that is the DIY thing almost doesn't help your case.
No, it does not.
They can push you back into... So the IRS code incentivizes you to make your hobbies businesses, but then tries to push you back into that hobby thing.
Why?
So you
collect
can take
more money.
deductions,
Yeah, that's right. Yep.
So it's kind of this vicious cycle that you got to defend yourself in and say, no, I'm a legitimate business, and hiring professionals, and
that's part of being in business.
Part of it. Education.
It's all part of it.
This education that they purchased, it's a tax write-off.
Yeah, it is. Yep. And don't think otherwise. If you were to sit down with a CPA and says, "Oh no, you can't deduct that," go find someone else.
Yeah. Yep.
Realistically, because what you're saying to yourself at that point is, you know what, my money isn't valued. I don't care about it. I can just lose a deduction and it's all good to me. No. Don't right. ever have that attitude.
Don't be afraid to upgrade your professionals.
That's right. So let's talk about some audit tips real quick. The funny thing about some of these that I list out, we deal with travel and auto and truck, depreciable items, which are like large assets. The IRS kind of takes a look at things and says, if you enjoy it, well, I don't know if that's a deduction. If you have too much pleasure in it, I don't want you to deduct that, right? Wow. Yeah. So if I have to travel for work, travel seems fun. I don't want to deduct that. In fact, it's been a few years, but they used to talk about like a priest or something, some evangelical, right, that had I guess you call it a flock or whatever the terminology you want to use. But if they went to see someone within their congregation and it was for an enjoyment purpose, they're like, oh, no, you can't deduct any of that stuff. If you go over there for some reason, church related, okay, now I'll give it to you. But if you enjoy it too much, no, I don't want to give that to you. So just be aware of it. So does that mean I can't deduct it? Absolutely not. That just means that I have to be more diligent with my documentation and my support for that particular instance. So if I'm traveling for work and I want to write it off, I've got to make sure I can demonstrate what was I doing while I was there, meetings I had, what was I looking at. I often say people come back, do a travel report.
Yeah.
Right? Just put a little folder together, all my receipts and stuff, a little memo of what I was doing, right, for support in order to write that stuff off.
Great thing to do on the plane ride home.
Plane ride home. Yep. Break out your computer. Boom. You're sitting there for a couple hours anyway.
Yeah.
Yeah. So just be aware of it. If there's too much enjoyment, I gotta be very diligent
Right.
in mine.
So Maylee and I, my wife, we have a strategy. Places that we like to go a lot. For example, we love going to Vegas. We're also both Disney freaks, so we're in Orlando and we're in Anaheim a lot, right? So the strategy that we've started implementing is, well, we're in real estate. Let's buy rental properties out there. Our travel will be for the purpose of checking on our rental properties.
Perfect.
You know, while we're in Orlando,
Of course.
let's hit Disneyland, or
Right.
Disney World, right? So,
Right. So what is the general purpose, right, of
Yeah.
my trip? I'm looking at, how do I spend my time? Sometimes you also look at, 51% of my time was devoted to this, and then the other 49%,
yeah,
But it comes down to its primary purpose. What is its primary purpose? And that demonstration will go a long way. Let me tell you about one of the, if I can, a little story. So this has been a number of years. We were dealing with one of our clients who happened to just, number selection, being audited. And we're sitting down with her, going through everything, putting all of our documentations in a row, talking through stuff. She was producing her receipts. And it was in Salt Lake City, and we'd go down to the IRS building in Salt Lake City. I don't know if you've ever been in an IRS building, but they're the most unwelcoming places you could possibly ever go. You know how you walk into a hospital and it's just very sterile?
Yeah.
They hang a picture of a flower on there and go, oh, look how welcoming it is. Well, no, that picture does nothing for me. So that's kind of how the IRS building is.
very much reminded me of the DMV.
Yeah, like the DMV.
Yeah.
It's there to make you a little uncomfortable.
Right.
You know what I mean? You walk in, I don't feel so good anymore. And maybe it was the burrito I just ate. I don't know, but
Hospitality's not a priority.
no, it's not. So we'd go there, at our appointed time. And the way that it was set up is you'd walk into the building and they had a hallway, and the hallways had doors, that were kind of numbered. And they'd say, "Oh, Mr. Jensen, welcome. You're door number 3 at 12:30." And so you'd go there and then you'd walk into the IRS room, and it was a room, and it had a table from wall to wall, and then it had a door on the far end, and that's where the IRS auditor would come in. So we walk in on one side, the IRS auditor comes in on the other side, a big long table separating both of us, so my client can't get over that table for the IRS agent can get out that door, right? So that's why I think they did it, honestly, right? Wall to wall,
Physical
make it
safety.
some physical separation here. So we get in there and we start going through all the various issues. I'm talking about, just her tax return, and we get to meals. Okay, everyone thinks meals. Oh, that's easy. Meals deduction 50%. Great. Just have your receipts. Well, that's true, but she whispered in our ear, "Hey, I have all the receipts. We already talked about this. And she brought them out of her kind of book or purse thing that she had that she was carrying all this stuff in, and set it up on the table. Okay, almost immediately, hands go over that stack of receipts. It was a healthy stack. And then we look at her and we say, "Listen, we need you to go step out into the hallway." Which she did, giving us some of the weirdest looks you could imagine, right? And then we look over at the IRS agent and we say, "Okay, listen. Our client had to step outside. She's feeling very overwhelmed through this process. It's very anxiety driven, as you well know. Is there any way that we can kind of take a break, regroup tomorrow, same time, we'll come back down, and let her kind of regather herself?" And the IRS agent said yes. Now, I don't know what he had going on, hungry, had to use the restroom, wanted to make a phone call. I have no idea. Honestly, I'm quite surprised that he agreed, but he said yes. We said, great. So we gathered up all of our things. He left. We went out, met our client in the hallway, and the client just gave us the what for. So what are you guys doing? I have every receipt, every single thing that we had talked about. Every penny is there, and we were going to have it supported. And we turned around, looked at her, and said, "You are about to lose the issue. You're going to lose it. I understand you had every receipt. You're going to lose the issue." Okay? Again, I keep harping on the same compliance issue.
Yeah.
The reason she's going to lose the issue is because when I looked down at those receipts, what did I not see?
Notes.
Ink. Exactly. No ink. What does that tell me? Okay? 5 things need to be on that receipt for it to be a mill deduction. Compliance. 3 of them are on every single receipt you ever get, no matter where you are. Date, place, amount. Every receipt has those 3 standard things. So the only two things you have to worry about is person and purpose. Who did I meet with, and what was the purpose of that? I like to call them person and purpose. You flip that receipt over with the pen after you just signed your credit card statement and you make a couple few notes, boom, deduction. You don't do that, take the 30 seconds to do that, bam.
No deduction.
No deduction, right? So we knew she was going to lose every single one of those because she didn't do it.
Yeah.
So we kind of went through this whole process with her. Next day we show back up, go back into the room. Our auditor comes in. She produces her receipts. Lo and behold, there's ink all over the place. Now, I'm not going to say I told her to go home and do it. I'm just going to say that when we went back there next day, there was ink all over. And boom, she won the issue. Okay? So, but that's what we have to think about when we're talking about tips is just that there are compliance things that we have to know, which forces us to do the documentation. I know we keep harping on that. But that's so important for financial decision making and audit support and tax return, creation and being able to produce those documents that need to go into the IRS every year. So just be aware of it, how important that issue really is. Okay, so some accounting tips. You came in, you're my new client. You said, hey, I use QuickBooks. What did I say? You're my favorite, right?
Right.
Because I know that you're taking the time to do it. And there are lots of software, and I mean, we live in this technology age that is so awesome. But utilize what's afforded to you.
Yeah.
Okay. When I started, again, going to date me quite a bit, but when I started with Ernst & Young, we were still using 7 columns as we were going through a bunch of this stuff, right? So thank goodness for nowadays with all the software that's out there and the computers that we can utilize. But use what's afforded to you. Like I use QuickBooks every day. But QuickBooks is a huge program. There's still things I'm going to run into that I don't know how to do.
Yeah.
Okay. Instead of calling QuickBooks, the very first thing I do is I jump onto YouTube and type in my issue. And someone goes in there and decides to throw up that issue because they get some endorphin rush off of likes, and like 5 other people had my same issue across the states. But I'm like so grateful that whoever in Minnesota decided to do that at 3 a.m. Thank you. Right. But then I can then go into QuickBooks and use it. So I wouldn't suggest you get necessarily your tax advice all from YouTube, no. Right? We have limits, but when it comes to software, right, and utilization of software and learning how to, even if it's Excel and doing tabbing and just take the time to utilize technology. It'll go a long, long way to producing a better tax return, better tax planning, and putting money back in into your pocket. Use technology and what's afforded to you. Okay, so I'm going to go through 3 quick takeaways. Okay, from what we've had. First one, be smart. Okay, let's be smart. We talked about our tax environment, adapting to this new tax environment. Be aware of what it is. You don't have to remember everything that we had talked about, today, but be aware of some generalities of discussion points that you can go sit down with your person and start to talk about. Okay, have partners in what you're doing. Okay, we talked about the do-it-yourself, maybe not the best strategy, right? Have the partners and what kind of team do I want to create? What kind of team around me do I want to create that's going to be beneficial for myself? And then understand how tax affect my business, both on when I make money, what do I owe, and my purchasing power when it comes to tax savings when I'm looking at all the things I need to buy, right? How can I save money there? Okay, second, 2, let's use common sense. Okay. Again, we said YouTube may not be the best place to get your tax advice. If you have a neighbor who drives a Maserati and just bought a Mastercraft and then comes over and tells you and says, I haven't paid taxes in 10 years, okay, 2 things is going on there. He's lying or he's lying, okay? One of those 2, right? So just be aware of where you're trying to get this tax advice from. Try to get it from at least someone who's qualified. And then you had touched on this as well. Try to go to someone who's familiar with your business, because they may know some things that will be extremely beneficial to you, especially when it comes to the real estate game. And then finally, your number 1 takeaway should be you're a business owner, act like it.
Yep.
Okay? Act like you own a business. Be aware of it. Put your motivation into it. Create the records that you need. Go out and find the deals that you need to do and track those things appropriately. If I want to go into business, I got to act like I'm in business.
Very cool. Well, thank you. That was so awesome, Joel. So tell me, if people want to connect with you and get more information from you, maybe even use your services, what's the best way for them to do that? Is that something that they can reach out to you on Facebook?
Oh, yes.
or-
So they can reach out to us here with Prime Corporate Services. We'd love to set up a time to talk to you, to see, even give you some tips and tricks, even if you didn't want to use us in the end, but at least have a conversation about your particular situation, because the tax code, is so personalized.
Right.
We got to kind of be able to say, okay, what do you have going on? How can we help you in certain areas? It's a free consultation. We would suggest that you do it, but totally up to you. But I think it would be beneficial.
And that's so awesome that, Joel, you and Steve and your team, we partnered up because I use these guys on a regular basis for both my tax and my legal needs. They have agreed to offer you guys, my students, a free consultation. So you can sit down with these guys and start putting together a strategy plan at no cost to you. Obviously, they've got some services that they can offer you, at a build rate, but to be able to sit down and start putting together a strategy and a structure around your taxes and around your legal, especially if real estate investing is something that you're getting into and starting to take seriously, make sure you do that. And the website that they've shared, that they've set up specifically for you, is primecorporateservices.com/Mitch-Nelson. primecorporateservices.com/Mitch-Nelson. Joel, what an amazing treasure trove of just awesome information today. Thank you so much for coming into the studio and sharing your time with us.
Thanks for having me.
Yeah, my pleasure.